For tax purposes, substantial presence is one of the ways that you become a U.S. taxpayer. Now remember that you can also be a citizen or have a green card. So substantial presence is only for those people that are in the U.S. on some sort of an immigrant visa, because if you had citizenship or a green card, you would already be a U.S. person. Now this is based on your time that is actually spent in the U.S. The way it works is you look at the current year and every day counts as one day. The year 1 year back, every day counts as a third of a day, and the year 2 years back, every day counts as 1/6 of a day. You add all of those up, and if it's more than 183, you become a U.S. person under substantial presence. This is a very important distinction because remember, we only have U.S. people and non-resident aliens in our tax system. So if you meet this test, you become taxed exactly the same as a citizen who's been here their whole life. That's why it's very important to do this. It's not just a little bit of taxation. You go from all to nothing very quickly. Based on the math with that, the safe harbor is 120 days per year. If you put that into the formula, it'll always add to 180, and therefore you won't fail the test. We have clients and people that plan their calendar to stay at that 120-day mark, so they never have to worry about it. However, if you do meet the test, there are a few exceptions. The first one is under our actual tax law. It's the closer connection exception. You basically have to prove that you have a home, your main domicile in a tax home in a foreign country. Now, this exempts you from being a U.S. person, which means you don't have to file or report foreign assets, foreign income, or anything else. You just have to file a form to actually make this election under the closer connection. This is hugely beneficial because you don't have to disclose a lot of information to the IRS. However, if you spend more than 183 days in the current year in the U.S., then the closer connection exception is no longer valid. You have to look to a tax treaty if you do have one. The tax treaty is the same test, looking at your domicile and your tax home. The difference, though, is it just exempts you from income tax. It doesn't exempt you from reporting. Therefore, you still have to do all of the reporting as if you were American, report foreign assets, foreign bank accounts, all of that. You just don't have to pay tax at the end of the day. So it's very important to try to see, first of all, do you even have the ability to claim it? Are you from a country that has a tax treaty? And if you don't want to disclose all that information, you have to make sure that you stay below that 183 days, so the closer connection is still an option for you. Lastly, the exception is certain visas don't count as days in the U.S. The most common one is a student visa. If you're in the U.S. under a student visa, those days don't actually start counting towards substantial presence until you're no longer in compliance with your student visa or it expires. So again, for people coming from overseas, this is a little bit easier to look at your calendar and figure out to stay less than those 120 days or plan for it if you're going to go over it to use one of the exceptions. However, if you're here in the border region with Mexico, it's really important to think about how often you're crossing the border, how often you're coming here, and do you need to file that form to take the closer connection exception or begin preparing your entire return to take the treaty exemption and then have to disclose a lot of information. So this is the one for immigrants that you really need to look for if you're spending too much time in the U.S. in any sort of visa, and make sure you get all your reporting done.